Also, thanks again for you guys plugging in Sequence. It's good to see 3 other customers, Attention, Combo, and Maple. I know we're behind time, so we can kick this off quite quickly. When you look back at your state of B2B monetization in 2025, what do you think you got wrong?
So I've now run this survey years in a row where I just ask a bunch of questions about how companies monetize. I've gotten like 240 or so responses each year. So ran it last year and then ran the most recent one a month or so ago. The last year one was fascinating is that outcome-based pricing was only like 5% of the market, but a lot of people thought they were going to move towards outcome-based pricing. That was the number one prediction in the research. That has not happened. The outcome-based adoption was actually flat year on year. And so that was something that I thought was going to happen a lot more quickly than it has. And in fact, what just has happened is an explosion of hybrid pricing models, credit models, usage models, more than outcome-based pricing. The other thing that I thought was interesting is in 2025, the biggest barrier to going more usage-based or credit-based was investor sentiment. Investors often had a hard time with the predictability. Was it real ARR? Usage models used to be seen as a negative in the investor community. This year's survey showed that investors are actually now pushing their portfolio companies to be more usage-based. There's a lot of VCs out there that are telling their portfolio companies get in the token path. Tokens are increasing 10x year on year or more. And so if you can attach your monetization to tokens, you're going to have some built-in growth. There's some of that's lazy advice, but in general, the investors went from being blocker of usage-based and hybrid pricing to now like a very big accelerant around those pricing models.
Yeah, and that's actually something we saw as well with our Series A, where like investors like that upside, and there's still probably not enough companies that are even charging for their overages. But I think you touched on outcome-based pricing, where we also found that as well from our own data. I think only 10% of companies have outcome-based pricing, and like there are a lot of aspirations, but what would need to change for that to go mainstream?
So I think outcome-based pricing feels like the holy grail, right? Like it's super aligned from an incentives perspective. You only make money when your customers are successful. I think it's easier for customers to understand than like token-based pricing, because tokens just feel like such a black box and so unpredictable versus, hey, you're going to pay us $1 for this outcome feels a lot more reasonable. And like, I love the message of it. I think the challenge is, I use this framework called, I call it CAMP, that in order for outcome-based pricing to work, you have to have consistency around what outcomes your customers are looking for. And so if you're selling a horizontal product, you have a mix of customers, they're often looking for different outcomes from the same product. You have to have attribution, so you have to prove that your product drove those outcomes, as opposed to your customers got those outcomes with a slight assist from your product. It needs to be measurable in real time, so you can't rely on the customer to self-report data. You have to have the source of truth, and your customers have to believe your data. And then you have to be able to predict outcomes with some certainty, and so help the customer estimate up front what the outcomes are going to look like and what their bill's going to look like. And in some cases, without that predictability, outcome-based pricing can have all the downsides of usage-based pricing, and then it's unpredictable. But now there's two metrics. There's a usage metric that's unpredictable, and there's a success metric that's unpredictable. So it can be extra hard to budget for. And not a lot of companies can really check all 4 of those boxes. Now, there are some that can. Like we had a portfolio company at OpenView called ChargeFlow that was in the chargeback recovery space. So when you sell a good online, a lot of people get it and then will dispute the transaction with their credit card, even though they received the good. Happens in a lot of industries. Mom and pop stores normally just don't even do anything. They don't know how to recover that revenue. It's a big dispute process with banks and credit cards. ChargeFlow just says, we'll integrate with your systems, we'll manage that on your behalf, we'll take 25% of whatever revenue we recover. Customers actually love that. There's no SaaS fee, it's all found revenue. So it's all something that there's one outcome customers want, there's attribution, hey, you've got this revenue in your bank account, they can measure it, and they can roughly predict it. They know their average win rate, it's within a certain bar, they know the amount of chargebacks that the customers have. And it's not a cost to the company, they're getting revenue, right? And it takes some of the sting off of outcome-based pricing. So it can work, and it's great when it could work, but I just don't think very many companies can really check those 4 criteria.
Yeah, that's something we see as well. And Yeah, so one of my favorite takes from your newest B2B monetization report was that like service companies should sell work positioning as a replacement to an incumbent. I think Accenture was the one that you gave in the example. And we've actually seen this with our own immigration law firm, Ellis, where they charge by successful case. If you're a founder and you have an employee do a H1B or an O1, you only get charged if that case is successful. And it worked really well, especially like transparent pricing on their website. I think that's the thing that lured us in. My question is, if it works in that specific case, like why haven't more service businesses done this? And do you think they will make the shift eventually?
Yeah, that's one of the biggest trends right now. I think both in services companies and in tech companies is this like, some people are calling it AI services, some services as a software. There's kind of this great like coming together of the two. And I think what's interesting is that there's a lot of services spend out there, probably significantly more services spend than there is tech spend. And so if you can go after that services budget, but then deliver it via technology and bring costs way down, that gives you a lot more flexibility to bill, for example, based on outcomes, or to bill at a significantly lower price point than competitors. But you're still selling for a lot higher price point than a traditional software company would charge for the similar type of thing. And I think the mentality is that this is often like there often has to be a combination of like forward deployed engineer or solutions involvement plus the technology. And then over time, you can automate more and more of the process. And so I think that is a growing trend in a lot of different spaces. I see it especially in vertical areas. I was actually just working with a company, a New York-based company in the e-commerce space, and they're a testing platform. So they do a lot of A/B testing support for their customers. If their customers often don't have someone that's going to be running tests all the time, they don't have that specialist. They need dev resources to build and run tests. They don't have the best ideas of what they should be testing on their site. And so the new offering that they're working towards right now is a service as a software offering where they say, we'll audit your site, we'll recommend tests, we'll manage 2 tests a month, including all of the development resourcing, and we'll give you a money back guarantee that if you haven't made enough upside from the tests in 3 months, we'll give you your money back. That's a pretty disruptive value proposition, and they're able to charge about 4 to 5 times what they could charge for their technology for this services offering. And so I think that people would be really hesitant to go with that play in the past because it wouldn't feel like a pure play tech business. But there's so much upside and it's a better customer experience and there's more budget if you can go after these opportunities. So I do see a lot more companies doing that.
Yeah, and so your friend CJ Gustafsson, who's like mostly metrics for anyone who's finance, I saw his newsletter yesterday about the fact that switching to usage-based pricing is a one-way door, and once you do it, it can't be undone. And I know every company here is looking to shift to consumption or usage. Where would you start the process if you were advising a company how to make the shift?
I used to think it was a one-way door, although it's funny how that's kind of changed. To me, the shift from, say, charging per seat or flat fees to usage-based, if you go full bore as a company, it's equivalent to going from on-prem to SaaS in the first place. And that, like when we went from on-prem to SaaS, we had to make sure customers were renewing. And so we had to add customer success as a function, right? We had to start adding more and more new features so that customers got more value over time. There was a lot more risk embedded in the model. And so in the early days of SaaS, the people saw SaaS as lower multiple revenue than they now see it as, although that's changing. But I think with seat-based to usage-based revenue, there's kind of similar mindset. If you're only getting paid if the customer is successful, there's no shelfware, there's nowhere to hide, but it kind of leads you to have a lot closer relationship with the customer. You have to really drive a lot more adoption, and the revenue is true. There's not customers paying $10,000 a month and having no seats, right? You're only really truly making money when customers are adopting the product. And so that way it requires a totally different operating model, a different level of resourcing for the customer success, a different way to think about the roadmap. A lot of product features become monetizable if you can drive more consumption with the product improvement. So it's a very different kind of business mindset, a lot of different metrics. But the thing is, the idea that it was a one-way door is very 2021, 2022 thinking. Now every company is some sort of hybrid. It's rare for me to meet a company that doesn't have multiple pricing models at the same time. There might be a platform fee with a usage upside, a seat-based fee plus consumption. There might be one offering that's consumption based and one offering that's flat fee, and they're segmented towards different industries or customer types. Everyone is running multiple monetization playbooks at the same time. I think Salesforce even has 5 different pricing models for their AI product that they're running at the same time, and they even just acquired Fin, which will add a 6th pricing model. And so this idea that like pricing is this massive overhaul and it's a one-way door and you can't change things, I think we're moving towards a model where everything's a lot more agile. Companies have to change a lot more frequently and be willing to run more complex monetization models, which just means a different kind of infrastructure to support that.
Yeah. I take back what I said. It's fine. I'll tell CJ that you disagree. But that's actually something we see as well. We're going public with our pricing white paper as well next week, which is taken from every company we've talked to over the last 2 years. And that was actually going to go to my next question. And I think you had it as well, where you found that 29% of customers now let customers choose between pricing models. And that's up 21% from a year ago. Is the next step that every company starts offering a menu of different pricing models for each? Or do you think it's just different pricing models spread out over different products?
So it can become overwhelming to really give the customer that much choice. I think that there's a maintaining multiple pricing models and then an enablement with the sales team around when to pitch different models, and probably having a primary model and a secondary model. And actually at OpenView, we had a portfolio company in the automation space that had a pricing model based on a combination of seats and amount and automation frequency. That worked extremely well for their enterprise customer base. But for their small business customer base, folks would often have 1 or 2 seats and then a good amount of consumption, but they would be hesitant about fully deploying the product. The consumption overages would be really painful and cause a lot of churn. And so it just wasn't really working as well. They faced high churn in that SMB segment and just not a lot of stickiness because they would have few champions. They moved towards a flat fee model of just saying, hey, look, if you're under a certain size, our pricing, we have 2 tiers, $500 a month and $1,000 a month. Both were a limited user, but kind of differentiated based on capabilities and usage. That was so much easier for customers to land on, and average selling price went up, retention went up by a lot, and their costs could support that level of usage because these were pretty small business customers that only had so much usage in the first place. They were never going to offer that model to the enterprise segment. They would lose so much money on the enterprise space. They don't even advertise that anywhere to the enterprise market. But having multiple models and having that flexibility across different segments just allowed them to have higher revenue potential across that base. And that's the kind of play I see more companies running versus being like, here's a menu of pricing, you go figure out what's best for you.
In my research as well, I saw that you said that credits is a lifeline, not an end game. What did you mean by that? What do you think is the end game?
Yeah, and this is something that it's had a lot more longevity than I thought, so we'll see how long this does last. My thought so credits a year ago, there were not that many companies selling credits a year ago or 18 months ago. And you'd probably be okay buying on a credit basis with your key vendors. But then as soon as you have a dozen or 24 vendors that are all charging you credits, you have to figure out how much to pre-commit to across those vendors. What does a credit give you with each vendor? Because the definitions are all different. Where should you allocate AI consumption? Also, how much should you commit in advance? Because things are changing so quickly, you don't necessarily know whether you're going to want to access AI capabilities through Anthropic and use Anthropic credits via MCP, through the vendor themselves first party. Imagine buying Figma credits, but then wanting to access Figma via MCP and but your usage estimate's totally off based on that. There's a lot of complexity and work great for your primary vendor. They don't work great when everyone's doing it. I think we've continued with them because there's not a lot of better options for pricing and costs are so unpredictable, and credits do kind of keep a floor on margins and ensure no one's unprofitable. But I just don't feel I feel like customers are going to push back, right? Especially as the pendulum shifts from token maxing to ROI maxing. It's just unsustainable for every single vendor to have credits. And where I see things going are in a few different directions. One is renewed interest in outcome-based pricing, which I predicted last year. I'm predicting it again, and maybe I'll be wrong again. Another route is having companies institute more of the Costco model. And like Clay actually did this recently. I think of this as like platform plus token pricing. So at Costco, you buy the membership, and then the goods are pretty low margin at Costco. right? Like that's kind of a loss leader. And they're pretty much just saying we're passing through those at cost with a small margin. Clay's basically doing that with their pricing too, where they're saying, hey, if you want to buy data credits through Clay, AI access through Clay, we're going to pass that on at, I think it's a 20% margin that they're charging. And they're going to have their store of value somewhere else, which is based on platform features and actions. But they're basically saying, hey, if you want to consume your Anthropic or your Apollo kind of data credits or whatever through Clay, great. If you want to do that yourself, maybe you can get a better deal and volume discount directly, go for it. And I think that's a model that like the vertical SaaS has done for a while, with software being high margin, payments being low margin, for example, where there's a host of industries that have these kind of two-sided monetization models. I see that working because then you can pretty much just tell the customer, we got these credits, we're passing on our volume discounts with you. We're not trying to gouge you on this. We have a fair price. We have a market price for you. You can use the most expensive models, the least expensive models. You can use open source models. You have the ability to optimize costs based on your own workflows. But our real value is what we're adding around it. It's the harness layer rather than the AI credits themselves. And I think that's a very hard shift to wrap your head around, because it means you're not getting like a 70, 80% margin on everything. You're getting 80% margin on the core value you're doing and a 20% margin on the pass through. And I think that's a cleaner model, easier to explain, but only a handful of vendors are doing that so far.
Okay, interesting. You touched on the token spending era and how it's gone now. And I think even so, a year ago, a lot of the sentiment was kind of on usage-based pricing was pushed by investors saying, you have to have this, you have to get your overages. But now, do you think as companies start seeing their margins deteriorate and it's no longer zero marginal cost on your revenue, do you think that's what's now going to push this usage-based pricing trend even further? Where it's not just your investor saying you need to tick a box and implement usage. Now your CEO realizes we need to actually expand our revenue more.
So yeah, there's the vendor side of this, and then there's the customer side of this. I think customers are looking at their bills and saying, how the hell are we spending hundreds of thousands of dollars on Anthropic? Like, when did that happen? And so there's a lot more, I think, people looking at that and saying, we had a mandate to drive AI adoption at the company. That was great, that's happening. Now we have a lot of workflows that are duplicate, that are not great, that should never have been rolled out in production in the first place. A lot of people use AI for personal productivity. Where I see things going is to say, hey, we have different AI budgets at the team level. Hey, it's like this team has X, this other team has Y. And then let products compete for that spend. Like that spend could come out of the foundation model providers, it can come out of OpenAI and Anthropic, but they could also come out of more traditional SaaS vendors that are harnesses with an AI layer, right? It shouldn't necessarily matter what consumes that budget. What should matter is that you're getting the result back. And I think that brings SaaS vendors back in play because they have more purpose-built tools and they also don't have intelligence applied everywhere. They have a mix of intelligence and more basic automation, which I think provides a better total cost. They also have the kind of core context that companies need rather than having to reinvent the context for every AI run. And so I think that presents an opportunity back for more traditional players, and then also means for the vendors themselves, there is still upside on AI. It's not a limited like token-based upside. It's upside if you can quantify that you have a better return for the dollar spent. And so that's, I think, where a lot more of the product marketing is going to need to go, is that, hey, Anthropic has really smart models. You can access Anthropic models through us. We just have a better harness, and we have better managing of costs so that you get the results you're looking for at half the cost per task than you would get via foundation model. And I think that's a pretty disruptive story, and that'll unlock a lot of upside for these vendors. But it's a nuanced story, and that's something that I don't think that many companies have been good at telling that story yet.
Got it. Okay, we have two quick questions, and then we'll open up the room to a Q&A. So I think one hot take, I want to hear, do you really think that AI agents will become the customer? And if so, how will software be packaged and priced?
So AI agents are already the customer in certain cases. If you've ever used Lovable, Claude Code to build a website, a landing page, an app, they're recommending databases to use. They're recommending hey, I want to embed text messaging in this. There's going to be a recommendation around what vendors to use. There's a lot of that happening. And what's fascinating to see the rise of agentic commerce. Mercury just announced agent credit cards, I think yesterday or this week. Ramp announced them a few months ago. There's a lot more guardrails to give agents access to budget, but also have transparency around it. So I do think that's going to happen, especially on the bleeding edge, more of the open claw users, like the people that are really AI pilled. But I think what's happening right now that's more interesting is AI is being used as a member of the buying committee. So not the buyer, but an influencer. People are turning to tools like ChatGPT and Claude to ask, hey, help me decide which vendors are best for my situation, evaluate the pros and cons, understand pricing. Profound just released a new study that showed the share of ChatGPT queries with some sort of commercial intent increased 50% year on year. And I actually just ran a study looking at the Cloud 100, which is like the top 100 private cloud companies, and ran a query through ChatGPT, Claude, Perplexity, Google AI Overviews, all the core kind of AI tools. And I just said, evaluate company X on pricing. And I looked at what sources did it reference, what was the sentiment, positive or negative. And what's fascinating is that owned pricing pages of the companies were actually rarely the primary source for data on pricing. The best company was actually Plaid, and their docs were cited more frequently than their pricing page itself was. And so the best companies actually have a lot more transparency around pricing to give the AI agents the context they need to know. And even if they don't publish pricing, they actually say in their docs, we do not provide this pricing. And that way the docs or the AI engines have a canonical reference about what the official policies of the company. And then they also monitor how pricing is talked about on third parties. The top 3 places where pricing information is actually pulled from in AI engines are Vendor, which has dedicated pricing pages for most SaaS companies. You guys probably have pages on Vendor and might not have realized it, but G2 and Reddit are the other 2 sources. But I think that to me, buyers are already looking at using these AI agents to get information about vendors and pricing. And if you don't have any transparency around your pricing, they're often going to hallucinate and probably not have a great sentiment. I did it with an AI native legal tech company that's like unicorn many times over, very prominent. The AI response was that pricing ranges from $100 to $2,500 per user per month. And in general, emphasize pricing is opaque, it's expensive, it's complex. The sentiment from these AI agents was so negative, and that's the type of thing that it clearly hasn't hurt them yet. But I think that's, as buyers turn to these AI engines, like that's going to be the type of thing that is going to be a really bad. That's really not what you want. That's not how you want your brand to show up externally, especially as AI has an important role in the buying process. And if we get all the way to agentic commerce, that'll be especially bad. But it's even difficult right now with AI as a buying committee member.
I know this is off topic from pricing, but I presume from that, you recommend that every company invests heavily in GEO and getting some sort of tool to monitor that?
Yeah, I'm a big fan of that personally. I actually found, so I track my new subscribers and where they come from. At the beginning of this year, like 5% came from AI engines. And that was what survey data tells me. People take a survey when they sign up to subscribe. My direct click data shows that the numbers are like laughable. The amount of direct referral traffic is so low because people don't click on something in ChatGPT. They go to Google and they go directly to your site. But now that number for me is above 15% and it's literally climbing weekly. These tools are a really critical way that people are finding which products to buy and doing research on products. And so the way I think about it is these are like, it's very different from SEO in that it's more of a brand and product marketing play. Yes, you need to be visible in AI engines, but really you need to control the sentiment and how you get talked about, who your product's for, what the advantages are, why your product over competitors, how to choose which plan to buy. Like all of that is information that people would prefer to consume on ChatGPT as an objective source. And so you need to make sure you understand how you're showing up from a pricing standpoint, but also just broader positioning.
Okay. Yeah. So the last question here as well. I know it's a small room, but what's the biggest pricing mess you've ever seen a company walk into? You don't have to name names or anything.
Yeah, so it used to be a lot of the messes that I used to see in pricing were just companies not changing anything for years. I worked with one company, it was a portfolio company actually, that didn't change pricing for 6 years. Instituting a pricing change was like impossible because they didn't have any infrastructure around it. They had no way of making a decision to do it. There's a lot of fear. Customers were not used to any sort of pricing changes. That was a mess. But now it's almost like the opposite's true. Some of these AI native companies I work with change pricing so frequently that the biggest mess is I can't even figure out what the current pricing is. There was one company I worked with that they literally made a pricing change on a call and then they tagged Cursor on Slack to update the pricing page. When the pricing page was updated, but then the in-app pricing communication was not, nor was the emails of that reference pricing, nor was some of the documentation in the business. And so now it's more of like, companies are trying to move so fast that I feel like a lot of the issues are just not even having clarity and then not being able to say, when we made this change, what was the impact? Did it improve acquisition? Did it hurt it? It's just really hard to tell if you don't have that level of documentation and rigor around pricing.
Okay, that's great. If any of you guys have any questions, we'd love to have them.